One more pocket which in a sense is looking slightly choppy today are the two-wheeler stocks, Eicher, Hero MotoCorp, Bajaj. Autos, well, you could say the impact of Delhi lockdown, Maharashtra lockdown is not going to be large. And, it's going to be a time of, it's going to be in a very measured manner, so the economic activity may not come down. But the problem is that same time last year, the fear was large and number of cases were low. Right now, the fear is less, but the number of cases are high. Since the number of cases are high, it surely and suddenly will have an impact when you see a family member, when you see something else happening to your relative. It just sours the sentiment. But Mahantesh, the evidence which has come from last 2 or 3 months seems to be indicating that two-wheeler stocks or two-wheeler sales have plateaued. Is there merit in looking at the last 2 or 3 data points and assuming that?
Right, two-wheeler sales seems to have plateaued, but then we have to remember there is a specific reason why two-wheeler sales have been plateauing, or for that matter, automobile sales in general were plateauing, because you were transitioning from Euro 5 to Euro 6. So there was a huge cost involved in this transition, which the manufacturers had to necessarily pass on. So under that background, the two-wheeler sales were as it is moderating or plateauing out. And just as the pandemic hit us, the plateauing effect was furthermore pronounced. That means we saw virtually zero growth when you look at a longish period, that is a 12-month period. There was a sales drop in the initial few months of the pandemic and thereafter a recovery, but net it has sort of moderated. So yes, the background created by Euro 6 is perhaps one reason why the two-wheeler sales are plateauing out. In fact, on a CAGR basis for several years, it's negative. But with this low base formed now, I sense that we should be seeing stronger growth momentum ahead.
How realistic is the fear in RBL and AU financials? These are banks which in a sense have unsecured loans, they have loans to SMEs, they have loans to perhaps the lower strata of the society. But the selling in AU or RBL, you think it's overdone?
It's very difficult to say, because the assessment has to be linked from hard numbers, and what hard numbers seem to suggest is that the NPA numbers are at least going down, even as the advances growth has been quite curtailed. Now these NPA numbers are coming down probably due to a statistical calculation led by regulatory forbearance, Supreme Court guidance or Supreme Court order, and so on and so forth. And as it is, the lending effect has been such that the lending is only to so-called credit-worthy kind of people. So it's becoming statistically seen that we don't seem to have worry on asset quality front, but recovery in terms of growth, in terms of advances growth, substantial advances growth, is going to be a tough ask going forward.
Well, all banks are trading with a negative bias. Can you see SBI? You look at even insurance stocks. Even you've got AMC. So the financial space in a sense is getting completely jammed. Kunal, we were talking about the Nifty struggling to find or hitting the support level again and again. But looks like today we bounce from there. Would you take heart from that, Kunal?
Yes, Nikunj. In fact, I was just discussing this earlier with Avan as well, that how that 14,300 is actually playing a very, very important and a key support for the index. So fourth attempt, even though the intraday low today, which is below 14,200, was one of the, I would say, slightly higher lows, or the low as compared to the previous 3 attempts on the indices. But then again, we've survived this intraday correction, and we've bounced back again about that 14,300 mark. So this is like half battle battle won for the markets, that we've pulled back again above that 14,300 level. Now, the critical aspect for the markets is that which are the sectors which the market's assuming if we put in across a scenario that the market bounce backs again and this 14,300 actually acts as a major support zone where the markets can go into a base building method and then try and go into a rally mode. If that happens, I think the major onus of that rally has to be from the banking names, because that's the more dependent sector on the market in terms of trend. Defensives like IT and pharma, they've played their part in last 4-5 weeks trying to balance out the losses from the other sectors like banking or real estate and etc. So I think the major onus of the recovery would probably depend on how the banks perform, and within that as well, specifically towards the key private sector bank names. So I think the first part of the recovery, which I think one could probably sense, is if the banking name starts to recover and they show signs of strong bullish price action. That's, I believe, could be a proof enough that maybe the short term or the medium term bottom for the indices could be in place. As of now, we can just hope and expect that this is what it plays out. But the bigger catch over here, or the bigger point to really think about, is that 14,300 level is the most important support. And if we manage to break below that, then I believe one more round of selling pressure could come back into the indices. But if we still hold on, then we can just hope that the bank nifty tends to recover and provides the helping hand which the market requires at this point of time.
Mahantesh, curious as to what your outlook is when it comes to the entire real estate space. We spoke with someone in the real estate sector who says that office space demand will rebound as things start normalizing, and that the fact that people have moved to work from home, they say it's been restricted only to a few smaller players. What is your sense when it comes to the real estate space? Demand actually meaningfully picking up and this emerging as a steady long-term bet? Are you convinced or not?
When it comes to the commercial real estate space, much of the consumption is linked to ITES kind of services, which have fortunately during the pandemic survived in terms of their business, in terms of their profitability. And therefore, when the pandemic eases out, you surely can see demand rebound back from these very sectors. But as you are aware, work from home kind of culture is gradually seeping in across all sectors. ITES is among the forefront sector that bats for a work from home kind of environment. In fact, some of the business that they derived, the so-called digital business that they derived, comes from this very process of digitizing a lot of activities conducted by global companies, particularly in the financial services space, to some of the other companies within the utility kind of space. So as far as India is concerned, while can potentially bounce back once the pandemic eases out, right now you asked me about the conviction of whether this will translate into any meaningful investment opportunity to be had among real estate companies. My answer is simply no. The backdrop also is that we are seeing very interest rise in the year ahead. We have seen inflation number adjusting higher. We have seen RBI actually hitting the upper band of its inflation forecast. And mind you, we have a large borrowing program of the government ahead of us. So all these factors would tell me that real estate sector, particularly in the commercial real estate sector, when the conviction is still not there.
Then what would be the thesis when it comes to the cement space as a whole? I just want to also understand how you're looking at ACC in terms of its numbers, what you believe could be doled out by the cement major today. Do you think that the high cost is going to dent margins in the long run? And if we're looking at a situation with these curbs and curfews, how long after do you think things could actually stabilize for cement?
On the background on the real estate side, the cement demand coming from the real estate side is not a significant portion. Much of the cement demand is actually coming from home building, which is individual home building across the country, pushed in some measure by the government's schemes. And the cement demand is also coming up because of rise in infrastructure activity, particularly road building activity, railway building kind of activities. So these activities are continuing unabated. Remember, even in this lockdown, construction services are being treated as essential services, unlike in the past where construction activities were clamped down upon. There are restrictions or there are conditions put on construction activities per se. But having said that, the outlook remains quite strong or robust for the cement companies. Mind you, we are also seeing that the margins for cement companies are generally rising because of the pricing effect. Prices are going up, or the companies are able to price better and better going forward. And therefore, the margin action come the volume uptick that we will soon see from the construction activities should mean the cement company should particularly do well relative to the market's bleak outlook.
Kunal, let's get in your take then on some individual stocks. What's the outlook on HDFC AMC on the charts, and have you had a look at Asian Paints?
So I think HDFC AMC is a stock which is still in a range, consolidating the last 3 months, February, I would say the end of January, start of February. From there on, it's been trading in this range of 2,800 as a support and 3,100 as a resistance. So, this is what markets generally do when the stocks do exceptionally well in a short span kind of a time frame. These stocks, they go through a time correction, trying to for the indicators to cool off and the indicators to come back to some sort of a short-term mean more points. I think this is where opportunity arises, where someone who's looking to enter into the stock who could probably have missed out on the previous run to try and enter back again. So I think at 2,800 approximately, it could be a good contrarian zone to enter into HDFC AMC. I think that should be a strong support level for the stock to eventually come back to 3,200, 3,300 level as well. So I think that's the call for the stock on the short-term charts.
Mahantesh, while US markets are holding on, bond yields have stabilized, Indian markets are underperforming because of local factors. What if US markets, they start coming down? Could it be a double whammy then?
No, I don't think that could be a double whammy effect as far as Indian markets is concerned. Underperformance is indeed due to the local factors. We have a far more tighter lockdown situation prevailing. We have, of course, the second wave coming in a big manner, and that has contributed to this underperformance. But then once the market has underperformed, the valuations also ease out, and therefore if the US markets do fall down, assuming that they do, I don't perceive that there would be any shake-up in as far as the valuations of Indian markets are concerned relative to what happens in US, and therefore I don't consider we will see any double whammy effect if that underperformance closes out simply because the US markets come down. We have more to worry about local factors, local earnings growth, than really talk about relative valuations right now to global markets such as US.
Mahantesh, is it a good time to, let's say, buy the solid businesses like an HFC, Canfin Home, HDFC, pretty much from the so-called stable crop?
Yeah, I think within the NBFC names, housing finance companies have always been better choices because their business model is far more robust, particularly from the asset quality point of view. we had a situation where we saw housing finance companies being shaken up when they went in for higher exposure of the LAP portfolio, the loan against property portfolio. That was some time ago, that was a few years ago. That shake-up now being through, most of the housing finance companies have adopted a very simple, robust business model. Margins are well protected. Most of these housing finance companies never face liquidity kind of constraints. They do not have any refinancing kind of problems. And generally speaking, even in a situation, even in a dire situation of the pandemic, there is a steady growth to be had when it comes to housing finance companies. We also had conducive government policies. Remember, some time ago, the Maharashtra government had reduced stamp duties on housing, for procuring properties and so on and so forth. That gave a boost to a little bit of boost to the real estate sector, but housing finance companies too gained in the bargain. Relative to other kind of financing businesses within the NBFC space, housing finance company present a better business model to invest in.
All right, let's get a move on then and focus in on the latest curfew restrictions or a one-week lockdown that has taken place in Delhi in order to take stock of the rising COVID cases, where over 21,000 fresh cases have been clocked in the last 24 hours. The Chief Minister stressed on the alarming health crisis in the state with less than 100 ICU beds left. My colleague Ruchi Bhatia joins in with the latest details. Perhaps inevitable, taking stock of the rising cases. Ruchi, run us through what the situation is starting 10 p.m. tonight with the lockdown, what remains open and what closed as the Chief Minister takes stock of the COVID crisis.
The situation in the national capital seems to be worsening. We are seeing over 25,000 cases being reported in the last 24 hours alone, and a positivity rate of close to 29.7%, which goes to show that 1 in every 3 people in the national capital is infected with coronavirus. There is a shortage of beds, there is a shortage of medical oxygen, as well as key important drugs like remdesivir, and which is why the Delhi government had no choice but to go ahead and extend the lockdown and the curfew. We're given to understand only essential services will be allowed and weddings will be allowed just up to 50 people. Having said that, a detailed order will be put out by the Delhi government very shortly, but this is coming in light of a severe situation that we're seeing in the national capital. The Delhi Chief Minister making it very clear that the health infrastructure is extremely stressed, and that is precisely the reason that the government has decided to extend the lockdown. This is coming, of course, in light of the trader body, Kate, also announcing that there will be a self-imposed lockdown that will be imposed by traders in many markets in Delhi. For example, big markets like Lajpat Nagar, Karol Bagh, and Chandni Chowk as well. Having said that, we're seeing that this lockdown is going to be a cause of concern for the migrant workers as well, and that's one of the reasons that the Delhi Chief Minister said, and he urged the migrant workers to stay within the national capital, not go out, hoping that the lockdown will be there only for about a week's time, and thereafter they will be able to keep a lid on the COVID numbers. So he has urged the migrant workers as well to stay within the city and ensure that all support will be provided as well to the migrant workers as well. But one cannot ignore the fact that the situation in the national capital is worsening, and the next few days will be very, very critical.
Thanks very much, Ruchi, for giving us those details. That certainly remains to be very critical over the next few days. But we interacted with some corporate voices to get in their views on this lockdown. Pushpa Bector of DLF Retail, as well as Nirmal Minda of Minda Industries, spoke about the lockdown move and the disruption amid the curfew.
Better prepared for, putting in things, swinging things into a lockdown mode? Of course we are. Are we better prepared as an industry to face financial ramifications? We do believe that once the cases are over, things should come back to normal. But it is, as an industry, we do believe in supporting what is the right thing, which is really at this point a curfew which is imposed by the government.
I think because there are not many supplies in our ecosystem as of now, everything is in Gurgaon in Haryana region. But with this lockdown, definitely we feel, and it is good for the country. I would say that the way that the cases were increasing, we were all worried about, and there was a fear. And I think the movement of the people, that let us see that whether they will allow the industrial worker to come. Many of the industrial worker come from Delhi to Gurgaon side and Gurgaon to Delhi side, and not only the worker operator but also the staff member. So we foresee a little bit of obstacle, but not much, I would say, because Delhi, mainly on the demand side, I would put it this way.
Okay, let's focus in on earnings then. And the street is watching out for what ACC delivers in this quarter. Are we going to see high cost dent margins, or will there be some sort of a demand comfort? The street is going in with pretty robust expectations. Vivek is here to break it down for us. Vivek?
Well, the cement universe earnings will kick off today with ACC delivering its numbers. Now, the numbers would be looked at a standalone basis. Now, remember, you cannot really compare most of the cement companies, most of the commodities earnings on a year-on-year basis. Remember, given the fact that the base effect last year was on a very, very low base. Now, despite that, when you're looking at the numbers, what most of the brokerages are indicating is that most of the cement companies or the cement universe sales volume growth should be somewhere in the range of 25 to 30%. Sequentially, demand momentum, according to most of the brokerages, a 10 to 12% rise is what they were anticipating. Now, when you're talking about ACC, revenues are seen higher by 21% at close to 4,250 crore. When you're talking about profitability is seen a little over 400 crore rupees. EBITDA is seen at close to 680 crore, and the margins are seen close to 16% levels. Now, when you're talking about some of the key factors to keep an eye out for, demand momentum as far as the industry growth is concerned was quite strong. Sales realization trends were quite strong, given the fact that pricing was quite strong in the quarter gone by. Margins are expected to soften sequentially as well, given the fact that higher cost pressures have come in, higher freight charges, higher petcoke prices. These are things that are expected to impact the margins quite significantly. Macquarie is expecting a sales growth volume actual figure of close to 8 million tons, and that would be a 21% jump on a year-on-year basis. Key factors to watch out for: number one, any commentary in terms of how the company as well as Ambuja, given the master supply agreement, how much it is contributing to the PBT. Recently in the Ambuja AGM, the management indicated that close to 5% of the PBT was being saved or was being added, given the fact that this master supply agreement is in place. Any further commentary on that would be something that the market would be keenly watching out for.
Thanks, Vivek, for filling us in with those details. What's the stock price up to ahead of its numbers? Well, down about 0.8% at 1867. Just a quick status check on the markets right now. 14,343. That's down about 274 points. It continues to look rather gloomy for the Sensex too. We're down 950 points in trade, with the broader markets as well seeing a 2% cash. Kunal, thanks so much for joining in. Let's slip into a very quick break. Come right back with lots more when we return. Welcome back. The fall seems to get quite exasperated yet again, as you have a 14,300 level just about being held on to. Now it's back down 2% for the frontline indices, 1,045 points off on the Sensex, and the broader market is continuing that downward slide. Check in on names like MMTC, Karur Vysya Bank. The entire banking sector, by the way, is under a major stroke of red. Ashoka Buildcon, NBCC, as well as Gayatri Projects, Federal Bank, Hindustan Copper, Kansai Nerolac, as well as DLF and AU Small Finance. They're struggling in today's trading session. But let's check in on Nestle, and that stock too is down about 0.8% at 1,100. We're watching out for these earnings come tomorrow. We're expecting volume growth to aid the overall numbers. There's going to be a lot of focus on the rural trends, but what are the headline numbers expected to be like? What are we expecting by way of margins? Let's take it across then to Vinny. She joins in with a summary. Vinny?
So it's the first FMCG company which has been posting its quarter, Jan to March quarter numbers. For Nestle, it's Q1 current year 20 numbers. Let's have a quick look at what we're expecting in terms of numbers. Obviously, for FMCG companies and most companies we have seen a low base last time as well. When we've seen the lockdown start and begin in March. So, there is a low base that we're seeing over there. So now in terms of revenues, we're expecting the revenues to grow by around 8.9% and come in at 3,621 crores. While in terms of the profits of the company, that's the bottom line, we're expecting a 12.9% growth on a year-on-year basis. In terms of margins, we're expecting around a 70 basis point expansion in margins. This is the EBITDA margins which I'm talking about, and we're expecting them to come at 24.6% versus 23.9%. Nestle normally generally does not give a volume growth number, but the inferred volume growth, what we'll be expecting at will be around 8 to 9% volume growth for the company. Obviously, strong growth in prepared dishes and improvement in out-of-home consumption portfolio is something that has aided the company in this Jan to March quarter as well. Sequentially, gross margins actually will be expanding this time around due to the lower milk prices YOY which we saw in this quarter, but sequentially they have seen an increase. So sequentially the milk prices have gone up, and that could, there's an inflation in raw materials. Sequentially gross margins will contract due to the pressure increasing on raw material prices. Obviously with the raw material prices increasing, we expect some impact on the EBITDA margins, but the company is taking cost optimization measures which is aiding the EBITDA margins. And we expect, in terms of company-wise, we expect the focus on new launches to resume, as well as rural also, which they've been focusing on. So let's keep an eye out on there. Other factors to watch out for will be in-home consumption trends. Any commentary over there, commentary on material cost outlook, what are they seeing over there, and what are the new demand trends, any supply challenges, what is the rural trend shaping up given the rise in the second wave of coronavirus cases, that we've started seeing coming in from April and second half of March. So let's keep an eye out on that.
Mahantesh, at what point in time you would say that IT is fairly valued? Because I'm trying to see what is the risk-reward ratio for IT. We all know that rupees weak. We all know that IT companies will report double-digit this year. We all know that IT companies will get more business in FY22. So markets do not rally, or stock prices do not appreciate when we all know. And in IT, we all know the basic facts.
So I think we have to rely on the traditional ratio, which gives a cue on how to look at the IT companies, and the traditional ratio is the PEG ratio, the price earnings versus the growth ratio. Most of the IT companies have good growth in the EPS, and that EPS growth is also backed by the fact that they periodically do buybacks. With that background in mind, if the PEG ratio of the IT company is anywhere below 1, I would rather stretch it and say that a PEG ratio below 1.3 is something which will look very attractive when it comes to the IT companies, and it's time therefore to get into IT companies. Most of the IT companies right now are in that zone of 1 to 1.2, not really 1.3. And here the PE ratio that we're talking about is, of course, the forward PE ratio as compared to the forward growth rate, EPS growth rate. And remember, there is also a potential for many of the IT companies to go in for those acquisitions that very often are EPS accretive. To answer your question, the traditional PEG ratio is something that we will look at to really infer whether it's the right time to get into IT companies or not. But having said that, it also doesn't mean that if the PEG ratio is somewhere around 1.5, it is time to exit IT companies. It only tells you that you should be underweight IT and not really be zero weights and completely exit out of the IT sector.
Right. Mahantesh, a follow-up question would be on a stock which we've discussed, I guess, n number of times. Tata Motors. Can Tata Motors finally outperform auto stocks? And that's largely because of its exposure to JLR. So the world is looking better, at least the developed economies, whether it's US or whether it's Europe. Is there merit in assuming that now IT, pharma, maybe a business like JLR, which are forward, which are global facing businesses, they will do better?
There's no denying the fact that JLR is a global facing company. JLR is at the forefront in terms of technologies as far as automobiles are concerned. But unfortunately, what is happening at JLR is it is facing a huge competitive pressure, not only from its traditional rivals, automobile rivals, but also from non-automobile rivals, particularly from the IT side. And JLR's efforts at equipping itself to face this kind of competition is quite costly from the capex point of view. So that's unfortunately the reality we have to face when it comes to JLR. Mind you, JLR has given us past shocks of all the R&D expenses that they have been spending. This will be the second time, this quarter, which is yet to be announced, this will be the second time in its history where they will take a write-down of past R&D expenses. What does it tell you? It just tells you that the company is spending huge amounts of money on R&D, and it is capitalizing, therefore showing its P&L a little bit rosy. And when when the worst times kind of come, they write it off. Their R&D expenditure is, in fact, I would say, inefficient given this backdrop of write-offs. So from a business point of view, while JLR has great brands, great market to look ahead to, from an investor's point of view and from a critical investor's point of view, we should be concerned about the R&D spends that JLR has been doing. We should be concerned about the competitive pressure that JLR is facing. And therefore, it is not really the time to invest in a company like Tata Motors.